We can hear you, sir.
All right, thanks, Chinaya. Okay, so tonight, first, we need to quickly round up on IFRS 8 on operating segments. We started it last weekend, and the first thing I mentioned on operating segments was to quickly identify that this standard is only applicable for entities that are listed on the stock exchange or that are in the process of listing their shares. So it therefore means that it's not all entities that are required to present segment information. It's not all entities. And in fact, if the company is a consolidated company that has subsidiaries, then it should prepare the segment information based on the consolidated report. It should extract those figures from this consolidated report. So we then looked at what an operating segment is. We said it is a component of an entity that engages in business activity which may earn revenue and incur expense, and whose operating results are regularly reviewed by a CODM. And I told you that a CODM is a person that allocates resources to each segment and assess their performance. So CODM could be anybody that does that in an organization and for whom discrete financial information is provided. That is, they provide information on that particular segment and they provide information on it regularly. So when it comes to segment information, we need to identify reportable segment. And a reportable segment is either an operating segment or an aggregation of operating segments that meets the quantitative threshold prescribed in IFRS 8. So a reportable segment can be either a single segment or an aggregation of operating segments. So we actually sorted that first, that a reportable segment can be an aggregation of operating segments. So before you can aggregate two or more operating segments, they need to be similar in these respects. Number one is they need to have similar products or services. The class of customers they serve should also be similar. The production process should be similar. The distribution process should be similar. And they need to have similar regulatory environment. It's only when these are present that you can say that you want to aggregate. Otherwise, you cannot aggregate them. They have to be seen individually. However, we say that yes, these 5 years, but there is a particular one that if that is not achieved, you cannot aggregate those segments, and which is that they need to have similar economic characteristics, meaning the macroeconomic variables that affect one of those segments should affect another. They need to be exposed to similar inflationary circumstance. They need to be exposed to similar political environment. They need to be exposed to similar business risk. And also their performance, their economic performance in terms of their profitability would therefore be similar. Before you can aggregate, this similar economic characteristics is the overriding criteria. That even if they are similar in all these regards, but they don't have similar economic characteristics in a way that the macroeconomic environment they face is not the same, you cannot aggregate. So basically, we expect that they should be in the same country, if possible, in the same state. Before you can say you want to aggregate two operating segments together and see them as one for the purpose of ascertaining a reportable segment. So after you have identified your whether you want to aggregate or whether you want to see them separately, to know whether they are reportable, they need to meet any of these three, just one of them. Number one is that operating segment revenue must be 10% or more. That's why I said at least 10% of the total segment revenue. Again, the profit or loss of that segment, the absolute profit or loss must be 10% or more of the greater between total profit of all segment that does not report a loss, total loss of all segment that does not make a profit. So we pick the higher, then we get 10% of that. If the operating segment or loss is higher than that 10%, then yeah, it qualifies. And also the operating segment assets should be 10% or more. Now, when you have used this criteria to identify operating segment, to identify reportable segment, now, before you can go ahead and present segment information, the total revenue of those reportable segments identified must be 75% or more of the total revenue of the entity. If it is not, you have to go and look for the next meaningful operating segment and make it a reportable segment, even if it does not meet the quantitative threshold, just so that we can make up that 75%. So this is very important. In fact, it's the most important thing in this topic. Yeah. And on that basis, we started solving questions. And that's what we're going to do for this class today. Now, before I go to the past questions that we have here, I have two past questions that we need to solve. Let's discuss this a little bit together. So number one, they say that can the CODM, Chief Operating Decision Maker, be a group of individuals? So I need you guys to participate if you have the energy. Let's have a little discussion on these ones, at least for like 10 minutes, just to strengthen our understanding on all we have learned. Anyone? Can
Yeah,
the chief operating decision maker be a group of individuals?
I will say yes, because in as far the board of directors can be a decision maker for such segments.
Okay, that's a good trial. Yes, they can be group of individuals, and the reason is that a CODM is a person whose responsibility is to allocate resources to the segment and also assess their performance. If an entity has a group of people that does that, no particular individual does that within the entity, then of course, yes, that's the CODM. So CODM is more of a function than person. So it could be one person, it could be whoever. But it's the function that make a CODM CODM. It could be like Ufoma said, the board of directors, it could be the MD, it could be the general manager, what defines a CODM is that whatever allocate resources and assess performance of segments within the organization, that is a CODM. Number two, it says, can a head office function a group of individuals be a CODM provided they are the ones responsible for allocation of resources and assessment. Number two, it says, can the head office function be an operating segment? Can the head office function be an operating segment? Who can try this?
Yes.
I don't think head office can function as operating segment because the other segment should be reporting under, yes, a head office reporting under the office. Don't know what that.
Okay. Okay. So yeah, you tried, but if you look at an operating segment, the overriding argument for an operating segment is what you should look at. And the overriding argument is three things. Number one is a component of an entity that carries on business activity which may earn revenue and incur expense. Does an head office, does it carry on business activity? It depends. It depends on what the head office is doing. There's some head office that they are the one that carry out, that's where they do, like for banks, for example, now, for banks, it might be the head office that they will have their treasury department that does, let's say, Forex for them. But if we have an head office that is just administrative activities or HR function, just to support other operations or other branches, that one is not carrying out any business activity. So the key question is that is the head office carrying on business activity? If the answer is yes, then it is or it can be an operating segment. So since this question is open, yes, a head office, a head office function can be an operating segment if it carries out business activities.
Because we are like now we have NNPC, we have headquarters in Abuja now. But we don't nothing is happening there over there.
Exactly. Exactly. So that one cannot be an operating segment. Abi?
Yes, sir. Cannot be.
Yeah.
Cannot be.
Number three, it says, can vertically integrated operations and call centers that earn no revenue be classified as an operating segment? So vertically integrated operations is an operations that provides input to another operation, that provides support. So an head office function can be a vertically integrated operations. So if you know what vertical means, it's something that goes up. So Vertically integrated operations and cost center. A cost center is I can say a segment of an organization that does not make money. You just actually, so again, for this is similar to my answer up there. So yes, a vertically integrated operations and cost centers that earn no revenue can be classified as an operating segment if it carries out business activities. And from the definition of an operating segment, it may not earn revenue. So the point about that, it does not earn revenue. So we didn't say it must. We said, if you look at the definition I gave you, it's a component of an entity that carries out business activity which may earn revenue. So it may not earn. So it may not. So an example is a research and development arm. Research and development arm of an entity. Even though it's a cost center, but it's carrying on business activity and it doesn't make money. It doesn't make money. So that can be an operating segment. Yes, it can be classified as an operating segment. So this one now, so now they are now asking almost the same thing. Yes, research and development function can be an operating segment for similar reasons mentioned in solution 3. Can a discontinued operations be an operating segment? Let me allow you to talk about this. Can anyone quickly or sharply talk about this?
Hello, good evening, sir. Can I try, sir?
Yes, please, Michael.
Yeah, discontinued operation is an operation that is no more functioning. So I don't think it can be, sir.
Okay, thank you very much, Michael. But I know that you're not in our class in the last one, or you were there, but you were at church. We explained discontinued
Sir, I have not
operation.
been in the class, so I have not been in the class, sir. So sorry.
Oh,
I have not
okay.
been around. I have not been around.
Okay, no problem. So we explained under IFRS 5 that discontinued operation is a component of an entity which is either disposed of or held for sale and is either a separate line of business or a separate geographical line of operation. And it could also be a coordinated plan to sell a component of an entity, which can be either a separate line of business or geographical area of operation. And an entity can have a discontinued operation that is just held for sale. A discontinued operation, according to IFRS 5, does not mean it has stopped operation. It could be a coordinated plan to stop. So it can still be functioning, but we have the intention, we have the plan to stop. So IFRS 5 is saying as soon as you have that plan to stop, you need to reclassify that entire segment as a discontinued operations. And we looked at how it is presented in the P&L, also in the statement of financial position. So yes, a discontinued operation can be an operating segment if it is still carrying on business activity. If it's still carrying on business that they have not sold it, if it's still held for sale and it's still functioning, they are still using it, it's still selling, it's still buying, all of that, then yes, it can be an operating segment. If operating segments are based on geography rather than product, can they still be aggregated? Well, now, so this one depends. If segments are based on, you know that geography means one segment is in Abuja, another one is in Lagos, another one is in Ikeja, another one is in Abuja, another one is in Zamfara, something like that. That's geography. So they can be aggregated as a single segment. They can be aggregated as a single segment if they have similar economic characteristics. That's how you should answer them, because this is the overriding criteria. You see those other ones having similar product or service. Yes, those ones are important. At least they have to meet one of them. But if this similar economic characteristics is not there, you cannot aggregate now. You cannot. Also, they say that can information about non-reportable segments be combined and disclosed as all other categories together with items that reconcile with? Okay, so what they are saying here is this, when you have identified reportable segments, so all those other operating segments that did not qualify as a reportable segment, we usually classify them as all other segment category. You just call them all other segments. Also, in addition to that, we usually, when we prepare segment information, we usually do a reconciliation between that segment information to our main financial statements. So by the time you break down all your segments into, you break them down and you say, okay, this is the revenue for all the segments. Let's say the total revenue for all the segments is 100 million. You need to reconcile it to the revenue in the financial statement. Maybe that one is 120. So you need to tell us, what's that difference? Like that. So we usually do a reconciliation statement that does that. So this one is saying that can we, both the reconciliation statement and other segments that are not reportable, can we put all of them together as all other category? No, we cannot. So we cannot combine them as all other category. So we cannot combine them as an all other category. So only non-reportable operating segments can be classified under all other category. The reconciliation of segment information to the statutory information. Statutory information is the IFRS. Should be done under a separate statement. We do that separately, not saying it should be part of all of that. No, we do that, we would separate that. Finally, when applying the 75% tests under IFRS 8, paragraph 15, should the next largest segment always be selected? You see, what they are saying here is this. You know that I talked about this 75% criteria, that when you have identified operating segments, that we expect that the total revenue of those, when we have identified reportable segments, I mentioned that the total revenue of those reportable segments should be 75% of more of the total revenue of the entity. So if it's not up to that, you need to identify the next meaningful segment. That's what they're asking here. That the next segment you're identifying, must it be the largest segment, the next one that is the largest? No, it doesn't have to be. No. It only has to be the next meaningful segment, which is the way the standard put it. The next meaningful segment. So it is left to the judgment of the management to decide the operating segments that will impact the decision making of the users if segment information is provided about this segment. Okay, so I intentionally came up with this question because it exposes you to a whole lot of things around operating segments. Okay, now let's look at these questions together. So let's hear another voice. And is Ifua in this class? Let me see.
Good evening.
How are you doing now?
Fine. Good evening, sir.
Yeah. Do you have the strength to read?
Of course I can, sir.
Okay, please. Let's read this A part first.
Okay. Question 9, May 2021. Question A. IFRS on operating segments establishes principles of reporting information by operating segments, that is, information about the different business activities of an entity and the different economic environment in which it operates. Required. Discuss the principles in IFRS 8 on operating segments for the determination of a company's reportable operating segments. 4 marks.
Okay, so I will not solve this for you. I would want you to write it yourself, and hopefully you share it with me, and I'll be able to respond. This week has been very busy for me, so I think one or two people share their assignments. There's Dami and there's Azumta. Very few of you usually do assignments. I think I've not responded to one of you today, but keep making those efforts. I'll definitely always respond as fast as I can. So try this yourself. So discuss the principles in IFRS 8 on operating segments for the determination of reportable segments. Okay, so let me just give you a clue here. So you need to talk about aggregation and quantitative threshold. That's what you need to talk about. But majorly, they are looking for quantitative threshold. But I need you to start with the aggregation, then you go to quantitative threshold. to get your mark around this. So try your hands. Just don't copy anything based on my explanation. Write something out. I'm sure you'll be fine. Now let's go to the B part, please. Yeah, Afua, please read.
Okay. The advisors of Amaka Limited have requested for various types of information from the company to facilitate the preparation of prospectus and other financial information in view of the fact that Amaka Limited is about to be listed on the Nigerian Stock Exchange. As the chief accountant of the company, the CEO has requested that you provide the advisors with necessary information of your company that you use to allocate resources and assess performance of the company in year 2019. You have therefore identified the following potential segments that could be reported on based on the areas of location of the company's operation in West Africa.
Okay.
Okay. Required. Explain how the principles highlighted in A above will be applied to Amaka Limited using the information provided. 12 marks. 2. Discuss other disclosures requirements which Amaka Limited should include in the financial statement for the year ended 31st December 2019 as required by IFRS. It's 4 marks.
Okay. This one too, I think I have to still give you the opportunity for this one. Maybe I'll just list this one for you. This disclosure requirement. But these other ones, they say you should explain how the criteria you mentioned I'm sure they're talking about the quantitative threshold. So the first thing is you just need, it's like more of application. So, and they didn't say just calculate. The examiner said explain. So you need to do some explanation. So that means you need to do the calculation first. Like for Gambia now. In fact, you do revenue tests. The way I did that one, there was one I did like this for you. You do revenue tests. You do for Gambia, for Ghana, for Nigeria, for Togo. So anyone that pass the 10%, you will say is reportable. You go to profit test. Anyone that has passed revenue, you know that you have to do profit test again. Otherwise, you'll be wasting fruitful time. So the one that has passed revenue, just go to profit. It's just the same question we have solved. You would go to assets. You don't need to do liabilities. Liabilities is not part of the test. It's not part of the quantitative threshold. So please use this question to practice that again. And now when you have now done your calculation, you now explain that based on the calculation above, this person is a reportable segment because he passed under revenue test, or he passed under, you explain it. And you explain the fact that because this person has passed under revenue, you didn't have to repeat it under profit because the criteria requires that you meet one of them. And since he has already passed on revenue, so you don't have to do the profit or loss test. You explain it for each geographical area, each reportable segment, one by one like that. You tell us where did Gambia pass, where did Ghana pass, where did Nigeria pass, where did Togo pass, and all of that. And that will have earned you your 12 marks, the calculation and the explanation. Then I said we should discuss the disclosure requirements. So for disclosure requirements, first, you need to explain to us the basis for determining reportable segments. You need to that you need to tell us basis for determining your own reportable segment. Is it based on revenue test? But you need to disclose how did they pass. Which of them in your financial statement? You need to tell us that you are including this company as a reportable segment because its revenue is something like that. You need to tell us the basis. You also need to identify the measurements of revenue. How did you measure the revenue of the segment? Revenue of the segment. How did you derive it? You need to tell us the measurement of profit or loss of the segment, and also the measurement of assets of the segment. So which are the three major key tests, and majorly what you disclose in your on the segment information. Some people give much more information than this, but majorly you'd disclose these three items. And also you need to give us details about aggregation of operating segment. And also you need to do a reconciliation between segment information and the statutory, meaning and the financial statements. The financial statements, it is statutory information. So there are much more disclosure that they do beyond this. I'm just trying to identify the simple ones that you can easily remember in case you are asked something like this in the exam. So please try and solve this yourself. It really helps you. If they ask it again, good for you. You would easily be able to attempt it. Okay, so let's look at this last one. This last question. Ifua, please, are you still there?
Yeah.
Okay, let's look at this last question.
Okay. Question 10. Agbero PLC is a public company rendering services to Lagos State government, especially in the area of public transport. Agbero is listed on the Lagos Stock Exchange. In its annual financial statements for the year ended 31st March 2018, Agbero PLC had identified the following operating segments. Segment 1, local bus operations. Segment 2, intercity bus operations. And segment 3, road constructions. The company disclosed two reportable segments. Segment 1 and 2 were aggregated into a single reportable operating segment. Operating segments 1 and 2 have been aggregated on the basis of their similar business characteristics and the nature of their products and services. In the local bus operations market, it is the Lagos State Local Transport Authority which awards the contract and pays Agbero PLC for its services. In the local bus operation market, contracts are awarded following a competitive tender process, and the ticket prices paid by passengers are set by and paid into the Lagos State Transport Authority. In the intercity bus operation market, ticket prices are set by Agbero, and the passengers pay Agbero for the service provided. Required 1. Advise Agbero PLC on how the above accounting issues should be dealt within its financial statement. This must. 2. Although the company is happy with IFRS 8 operating segment, hence its desire to comply with the above, it is not clear about who to designate as the chief operating decision maker in line with the standards. Define chief operating decision maker in line with IFRS 8 operating segment and identify who this should be in Agbero PSC.
Okay. Yeah, okay. Interesting. Very interesting question. So it goes to the very heart of your deep understanding of a reportable segment, that it's either a single segment or an aggregation of operating segment. And the question two is really trying to test your understanding of a CODM, right? So they're asking you to define a CODM and also tell us who can be a CODM. And I think we had actually done justice to that earlier on. So for this particular one, this company actually have three segments: local bus, intercity, road construction. So they have actually aggregated local bus segment and intercity because they believe they have similar business characteristics and the nature of their product and services are also similar. So they aggregated them together. However, they now gave us details about the two segments. They said that for the local bus operations market, they said it is the LAMATA, the Lagos State Local Transport Authority, that awards the contract and it pays Agbero for its services. And they say in the local bus operation also, contracts are awarded following a competitive tender process. And the ticket prices paid by passengers are set by the Lagos State. So for this segment, I think is highly regulated. Before you can get a transport job, you need to get contract from the government, and it's the government that determines the prices. It's the government that determines the prices. But in intercity, which is segment 2, ticket prices are set by Agbero, and the passengers pay Agbero for the services. So for the intercity, it is not the government. In fact, these ones are not regulated at all because they didn't say anything around the regulatory environment here. So apparently, is this company called Agbero PLC is the one that gives passengers tickets. It's the one that determines the price and all of that. So on the basis of information given to us, yes, these two companies might be servicing almost the same customer, people that want to travel, but their regulatory environment is not the same. Local bus is highly regulated. Intercity is not. Their economic characteristics are not the same. Prices are determined by the government for local bus, but in intercity, is the one that determines the prices. And even if you look further, the customer they are serving are not even the same. This one is serving people that are traveling intrastate, people that want to go to Oshodi, that want to go to Juelegba, that want to go to VI. These other segments does in that interstate is more risky. So they are not similar. They should not aggregate them. They should, in fact, disaggregate them. They are different reportable segments, and it should be treated as such. So this one also, write it down yourself. At least I'm putting assignment in front of it just so that you would remember to write it, hopefully. Yeah. And this final one, they ask us to define CODM. a CODM is a person that allocates resources and assess performance. And from this company, it could either be the MD or the general manager that can be CODM. Or any other director that does this allocation of resources and assessment of performance. Whoever does that is the CODM in the company. Could be the branch head, whoever. Just give them any name of one orga, the organization, or group of people, whether the board of directors of that company. Then you're good to go. So I need you to write that down yourself. Doing this goes a long way to help you in your exam. And we are done with segment information. Any question? I want to move to another topic. But before I move to another topic, I want to show you Dangote segment information. Just for viewing, just to see a live phone. I think I opened it earlier today. Where is it? Okay, let me go to my folder. Yeah, Dangote. Yeah, I have it here. Okay. Let me maximize it. Okay. Okay, I want to assume that you can see my screen. Okay, so this is the audited report of Dangote Cement for 2023. For 2023, yeah. So you look at their segment information. You see that segment information is in the notes to the account. Is note 6. So segment information is a disclosure. Okay, so as I was saying, segment IFRS 8 is a disclosure standard. It's not something you find in your P&L or something like that. It's just something you do in your notes. So you do segment information in the notes. You see that in this report is in note 6. So the first thing that they did was to describe the sources of revenue, that's product and services from which reportable segments derive revenue. They said that the Executive Management Committee is the CODM. You see that for Dangote now, they have an Executive Management Committee, which of course will be a group of individuals. In this case now, that's the CODM for Dangote. And we heard management has determined operating segments based on the information reported and reviewed by the Executive Management Committee for the purposes of allocating resources and assessing performance. You see, this is a live report though. I mean, that's the beauty of what I'm teaching you. If you follow through, the beauty of SBR is that that's what we do in real life. That's the beauty. It's not about you're teaching theory. It's not applying. What I'm teaching you is exactly the way it's exactly the way it is in practice. That's how you see it live. And he said the Executive Management Committee reviews internal management reports on at least on a quarterly basis. This internal prepared on the same basis as the accompanying consolidated and separate financial reports. Okay, so this is just explaining the basis of the operating segment, who the CODM is, the fact that they are the one that allocate resources and assess performance. They are just trying to comply with the standard. And they say segment information is presented in respect of group reportable segments. If you remember, I told you that if a company has consolidated, if it has subsidiaries and it prepares reports, it prepares a consolidated financial statement, he said segment information should be presented in respect of that consolidated report, and which is what these guys are confirming here. And they said for management purposes, the group is organized into business units by geographical areas. So that means this operating segment here is based on geographical areas in which the company operates. So it said the company has just two reportable segments based on location, Nigeria and Pan-Africa. Okay, so then I said segment revenue and result. So they said the following is an analysis of, so let me not bore you with reading everything. So this is the segment information about, they give us information about Nigeria and also the Pan-African, and they give us some central administrative costs, and they did some eliminations for reasons best known to them. So after doing this revenue, so they got a total. If you had time, I would just had done a kind of reconciliation, but usually in the exam, they will not ask you to do segment information. I'm just showing you. Then they do it information about the asset and all. And they went further on like that. And they explained the elimination adjustment that they did here. Yeah. It's interesting anyways. If you have time, now you should be reading this report. You really understand a lot of it like that. Okay, that's that for that. Let's go to interim. I will share the note for operating segment with you. Okay. Now let's go to interim financial reports. IAS 34. IAS 34 is known as interim financial reports. Now, as a form of introduction, you see, this standard, let's clarify this. Let's make it very clear that this standard does not mandate any entity to prepare and present an interim financial reports. So you are not mandated. So the requirements to prepare an interim financial report is based on the nation's requirements. For example, in Nigeria, the Security and Exchange Commission requires listed entities to prepare and present a quarterly and half-yearly reports and submit same to the SEC. And they said these reports must be submitted within 30 days. Within 30 days after the due date, which is either the end of the quarter or half yearly. And again, these reports must be presented and published in the dailies, either a popular newspaper, like newspaper house, and the company's website, if they have one. So mostly you find, and this thing happens, that is how it is in Nigeria. You see them putting it in newspapers, you see them putting it on their company's website. You can, if you care, you can just Google search it, you will see it on their website because it's a national requirement in Nigeria, which is our concern, right, as it is today. So, yes. So now, if it is required in Nigeria or in the country in which you operate, then fine. That is what this standard is meant for. So, this standard is only here to guide us, to guide on the preparation of an interim report. So if your country requires that you prepare an interim report, yes, that is when this guy comes in. That yes, we provide a guide on the preparation of an interim report. We'll guide you on how to prepare it. Now, having created a context for this, making you understand fully that whatever it is we are mentioning here is not compulsory if your country does not require. So the condition on which you can prepare this is that your country requires it, give it to them within 30 days, present it in the dailies on your company's website, then fine. You can then apply this IAS 34. So now the objective of IAS 34 is number one, to prescribe the content of an interim financial report. Number two is to prescribe the recognition and the measurement of items in the interim financial report. So, having identified that first, that is the objective. Before I go to the objective, let me also paint a picture around the scope that the content of an interim report should comprise solely information about new events and transactions. We don't want repetitions. It's only new events that we want to see. Don't come, if you don't have anything to present, maybe you should not present an interim report. It's only if there is new events between the beginning of the year and the interim and the end of the interim period. That is when you should prepare. If you don't have, because what we want to see are new events and transactions. Beyond that, we do not need you to. So what do you then prepare? So the standard says a lot about an interim report, okay, is either a set of complete financial statements or a condensed financial statement. So an entity can either want to follow strictly IAS 1, which is now IFRS 18, or you can just do a condensed, a summarized report. So usually people would do condensed. So the content would have condensed statement of profit or loss and other comprehensive income. We'll have condensed statement of financial position. We'll have condensed statements of cash flows. We'll have condensed statement of changes in equity, and also some explanatory notes to the condensed reports. Some explanatory notes to the condensed report. So this is the content of the condensed reports. Now, how do you recognize and measure the items here? So a few things we need to identify. So first is when you want to, the items in the condensed reports, the items in the condensed report or in the interim reports, the condensed interim reports must use similar accounting policies. Accounting policies is very important. Similar accounting policies as those of the most recent annual reports. So we don't expect any changes. And if there are changes in accounting policies, so it will be applied, changes will be applied retrospectively. So the major point here is this: the same accounting policy you used in the last year is what you should use. We don't want you to start developing it because it's new transactions, new events. For this year, use the same policy you use, accounting policy you used last year for them as it were. Additionally, when you want to recognize or prepare a condensed report, if the business or if the entity's business is a seasonal business, okay, where in some period they will have high profit in some. So that means you can prepare an interim report, let's say at a time where he's experiencing boom. So it might look as if he's doing well, and in the next interim, he might not do so well. So if your business is a seasonal business, so the entity must provide, so in addition to the interim report, the entity must provide additional information. The entity must provide additional information for the last 12 months. For the last 12 months to show its performance for at least a year, for at least the last 1 year. So it's just so that people would be able to do that comparison and understand. So if your entire report is at a time where your business is not doing so well, so by the time you provide this information, additional information for the last 12 months, then they can see your history and say, okay, yeah. So if you look at his report cumulatively, he's doing well. So he's not doing so bad. So that's why we expect that for those that are exposed to seasonality in their operations, they need to provide those additional information. Okay. Also, only material items should be recognized and disclosed in the interim financial report. We don't want unnecessary details. Boss only present material item, and the interim reports must have comparative information. You must present comparative information for us. Now, this one is very important. The items in the interim reports are measured based on year to date. So when you're doing your interim report, the measurement should be from beginning of the year to that interim period, year to date, in the sense that, let's say you are doing an half-yearly report, half-yearly. Let's say in the first quarter, you had an inventory that was, let's say, damaged, or you could not sell. So you wrote it off in the first quarter. But in the second quarter, you discovered that you could actually sell this inventory. That means when you are doing your half-yearly report, you will not report anything around damaged inventory, because that is not important anymore. So we focus more on year to date. We focus more on the year to what's happening as at this period, right? So it's based on year to date information, and it allows entities to make reasonable estimates to determine the amounts to be reported in the interim reports, and the areas where judgments are permitted includes, let me give you 5 areas for your exams. Number 1, intangible assets. So for year, so if an entity has, for example, if an entity has a development cost, okay, it can expense the development cost if it hasn't met the criteria for capitalization under IAS 38 as at the end of the interim period. So if it hasn't met the criteria for capitalization as at the end of the interim period, then it allows you to expense it, because IAS requires certain milestones to be met before you can capitalize development costs. Like there has to be board approval, regulatory approval, all of that. So if you haven't gotten all of that as at the interim period, just expense. Don't bother yourself explaining too much. So expense it. Additionally, when you have tax, yes, IAS 12, what I taught you around tax, this one, you can estimate, you can use the profits the profits at the interim date as a basis for determining the taxable profits on which the current tax will be determined. So you can use the profit as at the interim date, even though I still didn't mention that, but I mean, use your estimates. What's the profit as at this interim period? Apply the rate on that. You are allowed, even though that is not the tax you will pay and all of that, is the tax as at the year end, but this is an interim report, so go ahead. Also, provisions. So for provisions, you don't have to engage an expert for measurement of provisions. You know that when I taught you IAS 37, I told you that provisions is determined based on the best estimates of the future expenditure required to settle the present obligation. And I said that, how do you then determine best estimates? We said you should rely on past experience of recent transactions, and in some cases, you might have to engage an expert. So if it requires expert to determine provision, you don't just estimate. So we allow you to make estimates. You don't go all out to get this is an interim report, so you don't have to go and be getting an expert and be paying so much money because you want to do an interim report. Don't do that. Another one is inventory. Okay, inventory. So for inventory, so here too, there is no need for stock count. You know, IAS2 requires that to value your inventory, you need to count, then you get the balance. You don't have to do stock count to determine the value of inventory. You can adjust your selling price. You can simply remove the margin from selling price, remove the margin from the selling price to work back to the cost of inventory and use that as a basis to determine your inventory. And the other ones that we really allowed you latitude on how you determine the value of. Okay, so that is it for recognition and measurements. Now, having determined that, what are the periods covered by an interim report? So when you have an interim report, let's start with half-yearly reports. Half-yearly reports. So what's the period covered? Interim comparative period, because you have to do in your SOPL, if you are doing half-yearly reports, let's say, are you serious? That ends in, let's say, June 25. So you would have your SOPL should be from January to June 25. And the comparative period should also be from January to June of the previous period. Your SOFP should end as at June 2025, but surprisingly, this one has to end as at December 2024. The statement of cash flows should be from January to June 2025. Why this one will also be January to June 2024. And statement of changes in equity should be from January to June 2025. And this one also should be January to June 2024. But if the interim report is a quarterly report, let's say that ends in, let's say, September, I mean, the quarterly report is a 3-month report. So what are the periods required? So for your SOPL, you do your July to September 2025, and also your July to September 2024. But in addition to that, you must now do year to date. In addition, so you have to prepare 2 reports. For the interim reports, you prepare for the quarter and also year to date. They can ask you this in the exam. And you also do year to date for the comparative period as well. However, for your SOFP, statement of financial position is just like before, ending September 2025, while this is the end of the previous year. Your statement of cash flows year to date. It won't be for the quarter, but year to date. The comparative period also to date. And the statement of changes in equity year to date. Okay. And finally is the notes to the interim period. So we don't want too much bulkiness. In fact, we call it reduced notes. What we want to see are notes around new transactions, new events, like is there an acquisition or disposal of PP or intangible assets? That's a new transactions. Or is there a write-off of inventory that has occurred for that period? Or is there an impairment of financial assets? Financial asset that has happened for that period? Or did you dispose of, let me put it as, was there a business combination in that period? Or was there any correction of errors that occurred at that period? Or was there any changes in accounting policies? These are major things, new things that we want you to, or was there a reversal of provisions, like that? Or, trying again. It's plenty new things, or whether there was a settlement of court case, like that. They can ask you the relevant notes that can be presented in an interim report. Okay, so and that is it for an interim report. So let me show you something. Okay. Okay, Ifeoma, you can go ahead, please. Yeah, Charity, you can go ahead. I can see your hand.
Sir, you were so fast. Like, I did not get all those reduced notes to the interim report.
Oh, were you writing it down?
Yes, sir.
I will share the note with you.
Okay.
All right. So this is an interim report of Dangote, unaudited, for 3 months period, ended March. They have decided to adopt the condensed approach. So condensed, and it is based on consolidated reports. And if you look at their P&L for the group or the company, so for the group, they did P&L from January to March 25 and also January to March 24. The same thing for, and they provided all the details, all the notes are there. When we look at the notes, you will see they are very summarized notes. And also in the statement of financial position, yes, you will see that we have ending in March, interim reports ending in March, while the comparative period was as at December, the end of the previous year. That was the report they gave us, and they give us all the notes like that. Then the equity statements, that one is January to March. Cash flow also January to March. They prepare all their cash flows. So they mentioned issues around material accounting policies, just to show you that only material items were considered. Then they give us some breakdown of their revenue and even segment information for the group, and also the information breakdown of the cost of sales, everything. So let's see. The taxes also, I'm sure it was based on the interim profits. Now this is the PP breakdown. So no stories, it's just summarized and straight to the point. Like that. Okay, let me see. Facts. This year, because I can see projected unit credit method, I can see past service cost and all of that. So for these guys, if the standard even allows that, you don't have to follow those, you don't have to do past service cost and all of this for interim reports. You can just estimate those values for now. Don't engage anybody. But I think they went ahead to engage. And also information around contingent liabilities and contingent assets. And that was it for that report. And in May 2024, ICAN asked a question. I don't know whether you can see the ICAN question, but let me just share that. In May 2024, that was the last time they asked question on interim reports. So we're asked to discuss the conditions under which IAS 34 encourages public traded entities to publish. So, and I told you, this is only required where the regulatory bodies in that country it requires entities to prepare such a report. And in Nigeria, they do quarterly and annually. It's required, and they're supposed to submit that report within 30 days. In fact, they have to publish it within 60 days. And they have to publish it in dailies, on their website, and all of that. So that one is important, that they need to, that's a key condition. And the notes that should be included. So the notes should be about new transactions, new events, like if there is an acquisition or disposal of a subsidiary, if there is reversal of provisions, if you have impairment of financial assets, if there is correction of errors, changes in accounting policies, reversal of provisions, if there is write-off of inventory, those new things, those are the notes we want to see in the financial statement. And also they said, discuss giving relevant examples, the financial information that could be included in an interim report, where IAS 34 permits use of estimates. Yes, like inventory, for example, now. It permits use of estimates. Like you don't have to do inventory count. You can just adjust your selling price with the margin to work back to the costs. Even pension, when you want to do your pension, you don't have to engage an actuary to do a report. You can just estimate the pension costs. It allows estimates there. Your taxes can be based on the interim profits. Your intangible assets, you don't have to capitalize development costs, even if it does not meet the criteria at the interim report or as at the interim dates and all of that. So these are the kind of questions they can ask. They can come in a diet and ask you to tell us the periods presented for interim reports for both comparative and the interim period. So all of those little details that I gave you, I will share the notes with you, practice them. It's a very short standard, but that means they can ask any of those things. You need to know them and know them very, very well.